Thanks for clicking. Don't expect interest rate cuts in time for the spring real estate market. This according to almost zero realtors and Jerome Powell, chairman of the U.S. Federal Reserve, at a press conference on Wednesday.
I don't know who that is.
And Chair Powell is not the only one, with former Deputy Governor of the Bank of Canada, Paul Beaudry, also noting on Wednesday that he doesn't expect the bank to cut rates until June or July. Further, as we'll see at its press conference last week, the Bank of Canada also noted that the housing market taking off and potential inflation stemming therefrom was firmly on its radar. Yet, despite all the evidence, the usual suspects are continuing to pump up the FOMO, offering tales of multiple offer scenarios, which, of course, are being eaten up by the media.
They're gonna pay us top dollar because we are the best!
That movie was actually about car salesmen, not about realtors. No offense to car salesmen. Regardless, as we'll see today, signs are continuing to emerge that Canada won't be seeing those rate cuts which have been promised by the usual suspects. Which begs the question, if those rate cuts aren't in fact coming in time for the spring market, will we see the market reignite in the same manner as we did in 2023? So, what I want to do today is go over the latest in an abundance of evidence that the central banks won't be turning on the taps in time for the spring real estate market, take a look at the current market and how it compares to that of 2023's, and then discuss what to look for next. As we'll see today, how the spring market fares is dependent on a lot of yet to be answered questions, but we will continue to track its evolution on this channel throughout the year. Click like and subscribe if you want to get those updates, but for now, let's get into this Fed decision. Onto the Fed decision. As mentioned, Federal Reserve Chairman Jerome Powell announced on Wednesday that a March rate cut would not be likely, in that the Fed won't be confident by its March rate decision that inflation has in fact been defeated. I do want to briefly note that in watching Chair Powell's press conference, the chairman was asked far more often and in far more creative ways when the US can expect to get rate cuts. He was asked far more often than the 5 times that our own governor was asked at his press conference held last week. It actually made our journalists, if you want to call them that, look competent.
He says it, but he doesn't mean it.
Powell's message that we wouldn't be seeing imminent rate cuts standing in stark contrast to that which we heard in December, when the Fed said that we'd be seeing 3 rate cuts in 2024, and the markets took that to mean 6 by next week.
Or a dozen or so.
Given that Canada's interest rates traditionally run higher than that of the US, averaging about 60 basis points higher since the 1960s, it's unlikely that the Bank of Canada will be cutting at its March decision either. And, as mentioned, later than expected rate cuts were also echoed by former Deputy Governor of the Bank of Canada, Paul Beaudry, who said that if core inflation remains sticky, that we probably won't see the Bank of Canada rush to cut rates until mid-year, maybe even July, which makes sense. Canada's core inflation read surprised to the upside last month, paring back bets that the bank could cut rates in short order. And it wasn't just central bankers dousing hopes of rate cuts on Wednesday, with the latest GDP data in Canada coming in hotter than expected, pushing back bets that the bank will be cutting rates anytime soon. And some, including RBC, says that we should take the GDP data with a grain of salt. RBC also noted that it doesn't expect us to see those cuts until June either. This point was echoed by Doug Porter of the Bank of Montreal, who said that the GDP data could push back the Bank of Canada's plans to cut rates, and by TD, who also said that rate cut expectations could be pushed back as well. When even the banks, which are consistently wrong to the upside, meaning they are overly optimistic about the pace and severity of rate cuts, say that rate cuts aren't coming anytime soon, rate cuts probably aren't coming anytime soon.
Thanks. That's not a compliment.
And finally, Deputy Governor of the Bank of Canada, Carolyn Rogers, hinted as much at last week's press conference, when she noted that the bank is well aware that if house prices increase, which even realtors will admit that they will if the bank cuts rates, that the bank is well aware that those rising house prices will put upward pressure on inflation.
If we see an unexpected surge in house prices, that would, as you say, put upward pressure on inflation. So it is one of the risks.
So in just the past few days, we have Fed Chair Powell, former Deputy Governor of the Bank of Canada, Paul Beaudry, the banks all saying that we shouldn't expect to see rate cuts in time for the spring housing market. And then we have the usual suspects on social media. With that said, there are a few glaring similarities between 2024's market and that of 2023's. First, mortgage rates. Last year, going into the spring market, a decent 5-year fixed insured rate was sitting at 5.04, and as of the recording of this video, is now sitting at 5.14. So, the cost of borrowing and mortgage qualifications are basically where they were at this point in time last year. Further, prices are also very close to where they were last year, with the benchmark price of a home last year in December sitting at $724,000, and as of December of this year sitting at $730,000.
We are the best!
Last year, at this point in time, the media was discussing incoming signs of bidding wars, demonstrated by listings that were purposefully listed artificially low, and of course we've all seen the social media posts this year. So, very much like 2023, we are starting off the spring market with similar mortgage rates, similar qualification standards, and similar beginning house prices. Not to mention a media that is pushing the beginning of a hot real estate market. So, is this year going to be any different from last year, which saw the benchmark price rise $42,000 within the period of a few months?
If it's handled properly.
Well, there are a few differences from last year as well. If you'll remember, last year in March, yields plummeted downward just in time for the beginning of the spring real estate market. Yields plummeted on the U.S. banking crisis, sending the 5-year fixed rate down to 4.49. The facility that the Fed used to calm down the crisis last year is set to expire in March. With that said, the Fed could always extend the life of the facility, or the banks, which have been using that facility an awful lot as of late, could be in better shape this year. As we can see, they've gotten a lot of bad treasuries off their books. Also, although I haven't mentioned it much on this channel as I try to avoid hyperbole, events in the Middle East could send investors piling into treasuries at any point in time. Whenever anything major happens in the Middle East, investors pile into treasuries, sending prices upwards and yields down, hence putting downward pressure on mortgage rates.
That would be good.
That would be no good.
Then again, anything major happening in the Middle East does have the potential to send gas prices, and thus inflation, upwards as well. Further, as we talked about on this channel, we are seeing signs of stress in Canada's banking system. Minor signs of stress, but stress nonetheless, which could cause the Bank of Canada to end quantitative tightening earlier than expected, which would add another buyer of government bonds into the system, which again would put upward pressure on prices, downward pressure on yields, and then downward pressure on mortgage rates. So, we have the US banking system, problems in the Middle East, and the potential end of quantitative tightening, which all could put downward pressure on yields, which would put downward pressure on mortgage rates. With that said, as we've talked about so many times on this channel, the US is also set to issue an awful lot of debt over the next 3 months, which would, all things being equal, put upward pressure on yields and thus make mortgage rates go higher. Not to mention continually sticky inflation and continually hotter than expected economic numbers. So we have a number of competing variables pushing mortgage rates up and down over the next few months, and then we have the usual suspects purposefully underpricing homes and saying that additional interest in those homes is a demonstration that the market is heating back up, when, that is, the marketing savants that they aren't making fun of poor people for not being able to afford a down payment. Anyone see that story come out over the holidays?
No. Well, do it live! Do it live!
Regardless, we received a number of signs this week that we won't be seeing those interest rate cuts in time for the spring market, coming from Fed Chair Powell, coming from the Deputy Governor of the Bank of Canada, and coming from Canada's GDP data. With that said, there are some similarities between this market and last year's market in that we're starting the markets off in a very similar position. Similar mortgage rates, similar qualification standards, similar house prices to start off. With that said, we will continue to track Canada's real estate market, Canada's spring market as it unfolds, and how monetary policies coming out of Canada and the US will contribute to that market. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.